So it's not just let's avoid downside. It's, hey, let's look for buying opportunities that are more attractive today than they were 6 months ago, 12 months ago, 18 months ago, and maybe kind of tweak the exposures to capitalize on that. So we talked about the energy sector. It's up 30%. Probably not the time to go buy energy stocks. You probably missed that trade. Over the last 25 years, if you missed the 5 best trading days, you gave up about 30% of the total return of the stock market.
Hello and welcome to the Relax It's Retirement podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. I'm your producer, Wendy McConnell. Well, hello there, Josh. How are you today?
I'm wonderful today, Wendy. How are you?
I'm good, but you look like you're in a different spot to me.
New Pittsburgh studio. So we are fortunate today to be set up in the new studio. Still need to get maybe a couple decorations up on the wall, but we got the cameras set up, all the audio.
Are you elevated? Are you on like a second or third or fourth floor? Or?
On technically the 4th floor of the building. So
okay, so there won't be people walking by the window.
No one walking by the window, and it's the top floor, so no one walking above either.
Okay, so if we see someone walking by the window, there's going to be a problem.
Yeah, maybe a window washer might be the only interruption we get out the window.
Okay, so for the very first episode in the new podcast studio, how exciting, you do have a guest.
I do have a guest. We have Dominic Pappalardo joining us from Morningstar Wealth today. He's the Chief Wealth Strategist, and he's also in our office today because we have our annual State of the Union event with our clients, and this will be the first time we're able to host it in our new office in our Keystone room. So it's a very exciting day here at Leonard.
Very excited to be here, Josh. Thanks so much for having me today.
Yes. Yeah, absolutely. So we are going to pick apart the whole market today, Wendy. We're going to understand everything that's going on. Mm-hmm. We're going to start day trading based off of Dominic's advice, right?
Awesome.
No, we are not at all, right? One of the reasons that we've partnered with Morningstar over the years is, well, they have really sound research, right? Mm-hmm. Morningstar was founded out of that research. So we use Morningstar to help manage our clients' portfolios. They're one of the portfolio managers that we use along the way. So we have Dominic on to give some insight. You know, right now we just started a war, right?
There's just a lot going on. That's true.
There's a lot of concerns that we hear in the market now, but I think more importantly, we always have concerns, right?
Absolutely. There's never a day when you couldn't find a negative headline if you looked hard enough. And obviously the war is more significant than some of those other ones. But as you alluded to, that doesn't mean you should be reacting every time you see one.
Yeah, absolutely. At Morningstar, so looking at like your strategist team, how are you guys making adjustments with the war now?
Slowly.
Okay.
We're moving slowly. It really comes down to our long-term investment horizon, which you alluded to, avoiding day trading, right? And it takes some time to understand what the actual implications of these events are. So the very short-term implications are the spike in oil prices, interest rates are rising because inflation concerns are elevated. So there may be some small things to do today, but we're always mindful for our own portfolios and for our clients not to overreact emotionally to these short-term volatile moves that we see in the market driven by those headlines.
Awesome. Yeah, I think that holds true. Now, we know working with clients directly, sometimes we get the phone calls during this time period of, hey, you know what, should I be pulling my money out of the market? For us, a lot of that works to our planning framework of we have our 3 buckets, right? We have cash, which covers those short-term needs, right? If the roof starts leaking, the car breaks down, the water heater goes, we need that cash available. Beyond that, in retirement, we need to supplement income. So our more conservative assets fill up our income bucket for maybe a 5 to 10 year time period. And then the rest is growth. So we, coaching clients, will say, hey, well, this is your growth bucket, right? We have a 7 to 10 year time horizon. Help me understand a little bit how you guys see that longer term horizon. Is that a 5-year time period? Like when we're looking at the war, the spike in oil prices, how do you guys see that leveling out, and what sort of long-term perspective do you have in terms of years?
Yeah, great way to phrase it, Josh. And a lot of our expected return projections use a 10-year horizon. So very similar to that bucket that you described. And those don't move around quickly based on today's headlines or tomorrow's headlines. You need pretty significant fundamental changes in the economy or companies or the market to really move those numbers very much. Now, that being said, we still do look for those small pockets of opportunity. If an asset sells off below what we think is a fair value for it, we'll add to it, of course. But we're not making monumental shifts in our asset allocation models or really any of the portfolios that we manage. And people do sometimes question that. And then we just have them look back at history and we show the long run returns, how long the cycles last. And you could look at any period of time and when you look at the long run, they show up as little blips on the line, right? So we try to remind people that, hey, we've been through this and many other things before. The markets tend to survive. Sure, there's going to be some short-term volatility. 2026 has been interesting because the volatility has been both directions. We've had very big up days and very big down days, and they've almost netted out. I think we're down about 2.5% year to date. So despite the world-ending headlines we see every day, the market's down 2%. So in our view, not enough to monumentally shift your allocations or your long-term investment plan.
Okay. Yeah. And I think for me, naturally, I'm an optimist. So I very casually can say, no, this catastrophe is going to end. Not everyone feels that way. But if we look back, not that many years ago, we had COVID. And I think as an advisor, part of our job is coaching people through those periods. And that one was particularly scary for me. At that time, we're telling people, hey, stick with the long-term plan. But also, we're staying at home and we've never been in this. There's nothing in my mind that we can reference back to. One of the pieces of research that I referenced quite a few times during that was Morningstar's in terms of the market downturns and the amount of time it takes to get back. And if we remember during that COVID time, the market was in free fall, right? It was terrifying. We were all told to stay home. And then as soon as the government started backing everything up, we saw those prices shoot back up. And sure enough, as I tell clients all the time, we were still sitting at home in our PJs and the market was hitting all-time highs. To me, that's another reason, right? We want to stay invested. We want to have that long-term time horizon. Last night at dinner, we were talking about some of the stats that Morningstar has in terms of those time periods. How are you guys viewing that, like by asset class, but then also just as the market as a whole?
Yeah, certainly when you get those big drawdowns, it might be a time to add a little bit of risk to your portfolio. Maybe you bump up your growth allocation and reduce your fixed income allocation on the margin, right? Like I talked about, small tweaks, slow steps, always.
When you say on the margin, so like what sort of steps are you guys taking in, let's say like a typical retirement portfolio, right? Like a 60-40, how much of a shift would you be making in a highly volatile time?
Yeah, so there's two ways we think about it. So let's use your 60-40 target as an example. The stock market drops, you might end up being 2 or 3% underweight your target allocation. Well, the first step is just to rebalance to that previously stated target. So you may capture some of the price movement, buy back up to your target, remain where you were prior to that event occurring. That's kind of step one. Step two might be, okay, maybe I was 60% equity, I went down to 57. I'm back at 60. If it continues to cheapen up, maybe I bump it to 61 or 62. Again, small moves, couple percent on the margin. But if the valuation drops enough, that's something we think is justified and at least worth considering, depending on the client's time horizon, risk tolerance, so on and so forth. And I think the key point you made there, Josh, is how quickly the market has been bouncing back recently. One of my favorite stats to quote is you don't have to go back very far to 2025. When we had the Liberation Day tariff announcements in April, the market tanked. It was only down for 8 trading days, though. So you had a very small window to be able to jump back in and tweak your portfolio if you wanted to. So the resiliency of the market, which was a huge theme in 2025, in my view, is probably going to continue in the future. So I don't know when that inflection point will be, but I expect the bounce back to be rapid and unpredictable. So as you said, staying invested, staying on your targets is critical to that.
Yeah. I think the other one that we, our typical client is retired or transitioning into retirement. So typically at that life stage, we have all the money we're ever going to have, right? Unless we get an inheritance or win the lottery, right? But in most normal circumstances, that's all we have. So we get focused on that preservation and distribution, but we also still have a long timeline. So when we look at that volatility, we still want to be looking for opportunities in that. Alternately, we had a younger client come to us who had a liquidation event. They worked at a startup company. The
Okay.
company was bought and they received some money. And during this volatile time period, they're looking at the market saying it's going down. I'm not sure that I want to invest this money today. Right. Now, if we zoom out, and probably even for this gentleman, if he looks a couple of years from now, I'll say, oh, I should have planted the tree yesterday. Right. Talk a little bit about that timing of investing. If you were to receive a lump sum and start,
Yeah, timing is hard, right? That's the $1 million question for a lot of people. So either you stick to traditional dollar cost averaging, right? Maybe you leg in over a period of time, or maybe you start with an ultra conservative allocation and kind of bump up the risk over time just to level that off. Or you kind of bite the bullet and say, hey, this is my long-term plan. I'm committed to it, and we'll make adjustments in the future if we have to. So
how much of that do you think comes down to behavioral versus actual investment research? I think we were talking at dinner last night about missing the best trading days and some of the stats.
Absolutely. Yeah. I think the stat we like to quote is over the last 25 years, if you missed the 5 best trading days, you gave up about 30% of the total return of the stock market. So if you miss that timing, it could be extremely, extremely costly to your long-term outcome.
The whole New York financial scene and Chicago knows those exact days ahead of time, right?
Well, they haven't told me if they do, but if you can put me in touch with someone, I'll give them a call.
We talk a lot about, in terms of that market research and trying to find those things. There's companies spending billions of dollars to get maybe a 10 or 20 basis point advantage on something. So for us average folks that don't have billions of dollars to be deploying to find those slight advantages, it seems like one of the best ways is, well, stay invested, have appropriate timelines, right?
Yeah. And if you do happen to get it right, you were just lucky. And I think that almost is a disservice to people, because if they happen to get it right once or twice, then they think they can continue to call those market moves. And I've had conversations with people where they said, well, I saw this coming and I did X beforehand. And it's like, well, that's great, but you're probably not going to get it right again. So I think the word discipline comes to mind when we talk about that, right? You commit to your plan, you have discipline to adhere to it. That's one of the big jobs for an advisor, right? Is to remind their clients, like, hey, this is a thoughtful, strategic approach. We're going to stick to this. If things fundamentally change, we could revisit it. But until that happens, we need to stick to what we said we would do. And maybe you don't capture every single basis point of upside, but boy, you sure limit downside with that approach.
And typically that's when we get hurt the most, right? When we have a major market downturn, we make mistakes. Another piece of Morningstar research that we use a lot is going back to 2008, right? For a lot of our clients, they were looking at that time and they were younger then and working and maybe weren't quite as concerned about the volatility in the market. But when it drops that substantially, we all feel it. For them, maybe we have someone that said, oh, I knew it was coming and I pulled my money out and then I put it back in. Morningstar has one chart that looks, hey, if we pulled money out when the market was down in 2008 and we waited a year and then redeployed that money versus just staying invested, there's a substantial difference there.
Yeah, I think that's a key point, because really what you're saying is you have to be right twice.
Yes.
And it's hard enough to be right once, but getting it right twice to know when to buy back in is perhaps even more difficult. And the comments I made a moment ago, where the resiliency in the market is causing very rapid snapbacks, further compounds that second rebuy decision. So I think the risk of missing the upside is higher today than it had been in history. We have a lot, as you mentioned, we have a lot of very sophisticated traders that are moving things very quickly. We have much faster information flow today just because of technology and social media and a host of other things. So those snapbacks really do tend to happen faster today than they have at any other point in history, which compounds that risk of missing out.
Yeah, certainly. Certainly, that's always going to be a concern. Hey, can we get back in time if we were to step out? I know sometimes when clients have pushed on us really hard, hey, we need to maybe we'll take a small incremental change. Hey, let's put a little bit more cash aside in case we were to need it. And then we can wait out that volatile time and then reinvest. But it's really those knee-jerk or full reactions. You talked about making the adjustments in the portfolio of incremental change, right? We're not saying, hey, you know what, there's a war, we're getting completely out of equities and we're shoving everything in T-bills, right? I think that's where we can get hurt. Another concern that we have is like tech stocks, right?
Mhm.
I mean, these companies have been leading the market for a while. Now there's all the talk about AI and investment there. How's Morningstar viewing that and kind of building portfolios to weather a storm if there is one,
Sure.
but also take advantage of that growth while it's there?
Yeah, it's a really interesting situation because in 2025, if you were an AI company, the market really rewarded you. In 2026, that reversed a little bit. And through January, February, and March is noisy because of the war, but some tech stocks, software stocks really sold off in 2026. So I think it's just another reminder that things could shift quickly. When I get asked a lot, is AI a bubble? And I always say, not yet. And the
Okay.
reason I say it that way is we've seen really significant earnings growth for AI providers. And that's been great. The market's rewarded them for that. My concern is at some point, the buyers of AI have to start showing material gains from those investments. So NVIDIA's clients have to show meaningful returns on the money they're spending. We're not quite there yet. We'll probably get there. We just haven't yet. There's also a chance we don't. And then it could perhaps turn into a bubble. So my not yet answer isn't a cop out. It's just saying we don't have all the information yet. We've seen earnings growth. We've seen revenue growth by huge amounts. So it's definitely not a bubble today. But until we see firms really benefit from buying AI technologies, I'm not sure it can continue in the straight line that we've seen. And there's been marginal gains. Companies pick up some efficiencies. Maybe you could reduce your entry-level staff a little bit, but that's nowhere near justifying the billions and billions of dollars that are being invested in it. So how we think about it is it still comes down to valuation, Josh. If the valuation of a company that's in AI makes sense to us, we're comfortable investing in it.
Sure.
If the valuation is unreasonable, meaning the price is just too high, despite how great that company might be, we'll probably avoid it or at least be underweight the exposure there. So we really still bring it back to that fundamental analysis. What is the price that I'm paying for this growth? And then we determine if that's reasonable or not based on our fair value estimates.
Makes sense. So taking that approach, would that position you better to avoid like a tech bubble crash in the early 2000s, right? Where if you threw .com at the end, similar to .ai now, right? We get a higher valuation.
Yeah, no doubt. And obviously limiting downside is always a goal of any investment portfolio. And over time, again, using that long-term horizon, valuation tends to be the number one factor in outcome of an investment. And if your horizon's long enough, valuations do kind of reset to what they should be. The tech run has been longer than most cycles, let's call it 3-4 years, right? Again, starting to reverse a little in 2026. But we think that's a buying opportunity. There's some tech names out there. Microsoft is one, ServiceNow is one, software providers that we think are trading well below their fair value. And we're not necessarily loading up on them, but again, on the margin, we've added some exposure and we'll be watching certain names, certain sectors, hopefully to add more in the future if those price declines continue. So it's not just let's avoid downside. It's, hey, let's look for buying opportunities that are more attractive today than they were 6 months ago, 12 months ago, 18 months ago, and maybe kind of tweak the exposures to capitalize on that.
I think also going back to 2000, we've read a lot that, hey, at that time, a lot of these companies had no cash flow. It was all, now there's, what you mentioned, Microsoft. There's some very substantial companies that are making these investments. Now, they have cash flow from other sources, right?
Yeah. Fundamentally, they're very, very strong. And that compounds the difficulty of the decision a little bit because you look at their balance sheet and many of them are bulletproof, right? NVIDIA, Microsoft, Amazon, Meta, like just go down the list. Coming into 2026, very little debt, right? Tons of cash on hand, great cash flow. But again, the price was just over rewarding the growth. And we're not sure if that growth will continue. But fundamentally, they're great businesses. We wish the prices were cheaper because we'd love to own those companies, where it makes sense to. But in 2026, we've actually seen some of these companies start to add debt to their balance sheet. Not enough where it's concerning, but something to watch. Again, if that trend continues, maybe they keep adding debt. If revenue or earnings growth slow, now you may have to revisit some of those fair value estimates. Again, we're a long way from that today. I'm not sounding the alarm on Microsoft. But some of those tech companies, for the first time in their history, have started to add debt to their balance sheet.
Interesting. I think talking about debt, I want to pivot this to bonds a little bit, right? So in 2022, we saw a pretty substantial pullback in bonds, right?
The worst year ever.
And for retirees, that was supposed to be our safe money, right? That was the keel or the ballast of our sailboat, right? It was going to keep us balanced. We saw that pull back. Now, the trade-off there is, well, we have higher savings rates now, right? We were combating inflation. Rates went higher. How are you guys adjusting for the market now? And how do you see the bond market or kind of that debt market moving forward?
Sure. So 2022 was very unique. 2022 was horrible for fixed income investors. And the reason for the downturn in 2022 was the starting yields coming into that year. So the 10-year treasury was about 1.5% coming into 2022. We had rapid increases. The Fed was hiking rates. Inflation was moving to double-digit levels. All of that compounded yield movement upward. As yields go up on bonds, prices fall in line with that. So it wasn't so much that rates rose. It was that rates rose from a very, very low starting point. So there was no income cushion being provided to offset the price movement. Roll that forward to 2026. We came into 2026 with the 10-year treasury over 4%. It's at 4.3% today. That's a 4+% cushion to absorb those first moves of prices lower. So if rates continue to go higher, you're not going to lose money like you did in 2022 because you have that 4.3% income cushion supporting the overall portfolio value. So in other words, right now, fixed income can behave like fixed income and provide that coupon income to the portfolio and insulate the downward price moves a little bit. So it's unlikely to repeat what we saw in 2022.
While we took the hit, now it is a more sustainable market moving forward.
Absolutely.
How do you guys view, what we've seen, at least in my opinion, when we have any sort of economic major issue where the stock market starts to fall, is the Fed's drastically lowering rates very quickly, right? We've seen this kind of through the last couple major cycles. Now we got more space to lower rates. If the war, whatever scenario comes up, right, whatever the next catastrophe is, do you think that the Fed's going to take that same action? And then how does that impact the bond market, the stock market? How would you guys be adjusting in that sort of environment?
So this time's different, Josh.
Yeah,
and,
every time
is
right?
different, but this time is certainly different. I believe the Fed would love to cut interest rates today. They actually had a meeting 2 days ago. They held pat. They did nothing, no change in interest rates. My suspicion is they would love to lower interest rates because we're seeing weaker employment numbers. We're seeing GDP revisions going lower from last year. So macroeconomic data is trending a little bit downward. The Fed cannot lower interest rates today because they're concerned about inflation. Inflation is above target. They have a stated 2% target. We were 2.5, 2.6% coming into this year. Higher than target, but not alarming by any stretch. However, as the war started, we've seen oil spike, interest rate spike. All of that is because of inflation concerns. As the price of oil goes up, the price of goods and services go up. Oil is a major input to many products and services that consumers and businesses depend on. So the Fed is very concerned right now about inflation increasing from a rate that's already above target. So I think they're going to be much more hesitant to cut rates in this environment than they would be in a typical quote unquote crisis event like a war. So
do you think that puts us at a different risk then? Like in the equity market, hey, it seems like we're able to help the market rebound quicker by cutting rates. It's cheaper for a business to lend money to then hopefully keep people employed or employ more people to grow the economy.
It could be. It depends on the duration of the conflict in the Middle East. If it goes on for another couple of weeks and starts to subside, oil comes back down, no big deal. If it goes on for 6 months, very different scenario. It will probably put a drag on equity performance for some period of time. Certain sectors more than others. Obviously, energy stocks are doing great this year. The energy sector is up 30% year to date in 2.5 months. So certain pockets are benefiting. But overall, if interest rates stay high, inflation concerns persist, it will be a drag on equity performance. And, the depth of that drawdown will depend on the length of the conflict in the Middle East.
I mean, certainly, today we've talked about AI, we've talked about the war, we talked a little bit about inflation. What are major things that you guys are looking at or your investment team is kind of uncovering at this point that maybe isn't in the focus in the news?
Yeah. So what we're trying to capitalize on is dispersion in performance. So we talked about the energy sector. It's up 30%. Probably not the time to go buy energy stocks. You probably missed that trade, for better or worse. Other sectors like financial services are down almost 15% year to date. So that's a 45% performance gap for sectors within the US. There's probably a story there, right?
Sure.
Again, we haven't solved that puzzle yet, but those are the things we're watching for. We've been overweight healthcare. Healthcare earnings were actually growing faster than the overall market in 2025, but the prices were lagging the overall market. So you had two lines going in opposite directions. Those lines have started to converge in 2026. So we're looking for situations like that where fundamental strength is not reflected in pricing. Financial services might be something we look at in the future. What's also interesting is that same dispersion phenomenon applies to geographical diversification. So not every country is being impacted equally by the conflict in the Middle East. The US is holding up reasonably well. Some other foreign countries are not holding up so well. Asia specifically comes to mind. Asia's challenged because they rely on the Middle East for nearly all of their oil. With the Strait of Hormuz being shut down, there is no alternative route for oil to get to Asia. The US is very different. The US produces much of our own energy. Theoretically, we could be energy independent. So we're not directly impacted by that. We're still impacted because global demand pushes the price up, but we're in no danger of not getting oil.
Sure. We're having those shortages that we saw back in the 70s or whatever.
Asia does have that risk at some point in time. So we're looking at Japan. Japan has sold off pretty dramatically, 3 or 4 times the amount that the US has sold off. So that might be a trade in the future if Japan continues to cheapen up, but their fundamentals remain solid. That might be a buying opportunity that we reallocate to. We're also looking at emerging markets very aggressively. That was one of the small tweaks we made. We added some emerging market exposure in portfolios, particularly in Latin America. Why? Latin America exports energy, exports oil. So they're theoretically benefiting from the higher oil prices. Local companies are growing their margins because they're selling oil at higher prices today. And they sold off because emerging markets are always a bit more volatile than developed markets. So we saw this. They sold off more than the US, more than Europe, but they probably should be benefiting a little bit. Didn't quite check out to us there. So we added a bit more exposure to Latin America because of that. So we're looking for those opportunities where the reaction is uneven from the same headlines, trying to find value that way.
I think international markets come to mind a lot with folks. They'd say, hey, you know what? If we look over the last 10 years, there wasn't as much opportunity, right? We'll just buy domestic stocks because we're more comfortable with that. I think last year we certainly saw a gap in performance there. So when you guys are making those weighting decisions in a portfolio, you just talked about looking through those individual countries. But if we look just simply domestic versus international, how do you guys think about that? In terms of weighting?
Yeah, that's a key decision, a key allocation point for the portfolios. We've been overweight non-US stocks for a while. And for a couple of years, it hurt. It was painful because, as you said, the US was far and away leading global markets. That trend reversed strongly in 2025. The US lagged almost every major equity market globally. Countries like South Korea, for example, were up 100% last year. Brazil was up 40% last year.
So that's a reason to put 100% of your money there, right? Well, year after.
Yeah. I mean, that wouldn't have worked out well for you. Although actually, Korea is still up 25% year to date this year. So they've had quite a bull run. What's challenging about that, though, is it's Korea, for example, it's a very concentrated market. It's not diversified exposure. It's a very small part of the global index, for example. So those are major there's high volatility around significant allocations to country like that. So when it works, it's great. But if it can go up 100%, what do we think could happen on the downside if it reverses? Absolutely. So I would caution people not to chase those and not to over allocate to those highly volatile buckets of the marketplace. But your point about 2025 is really important because you never know what the tipping point is going to be. 2025 was unique because we saw the US dollar sell off about 10% in 2025. That hadn't happened in a really long time, probably a decade since we've seen a move like that. In 2026, we're seeing the dollar rally back a little because we're having some of that traditional flight to quality reaction based on the war in the Middle East. So there's more flow coming into the US dollar in 2026, whereas 2025 saw outflows from US dollar investments. So when you overlay the currency component, some of these things get pretty complicated and the analysis is pretty complex. So a lot of moving parts, which further compounds kind of that sizing decision a little bit. So we're prudent about it. We will be overweight, we will be underweight, but we try to be really prudent and put guardrails around the size of those trades.
Yeah. I certainly appreciate your insight, Tom, today. I think that is such a key point of why we choose to work with Morningstar with many of our clients is we see, hey, there's this research and there's deep thought behind it, but also not those knee-jerk reactions or, hey, there's volatility in the market, so we got to hide, right? Rather, there's opportunity, right? Yeah. Anytime we get a bag of lemons, we can make lemonade, right?
Absolutely. And, we think we're in a good position because we have local offices in these regions too. We have a big office in London. We have an Australian office. We have Asian folks in the regions doing the research. So more so than somebody sitting in Chicago trying to understand what's happening in Korea, it's much easier if you have somebody in Asia doing that work. And obviously we communicate on a regular basis with those folks. So it's kind of a nice perk of working there where I get to talk to people directly, boots on the ground in those regions.
Yeah, it's phenomenal and great work that you guys do. Helps reinforce some of those lessons that we might have been taught as a child, right? Like buy and hold, right? Now, we've talked about adjusting portfolios, but that is still often a buy and hold strategy, right? You had talked about those incremental changes.
Yes.
Not going 100% to South Korea because it returned 100%, right? So balancing that back out.
Yep.
Well, Dom, I certainly appreciate your insights today. And Wendy, thanks a lot for joining us today. If listeners want to learn more about Morningstar, we'll provide some links in there. And if they want to talk more about the portfolios that you guys help us manage, you can schedule a 15-minute call. We'd be happy to connect you with a member of our team or a member of Morningstar's team as well. Thanks again, everyone, for listening. And remember to retire with intent so you can live your golden years with the happiness and excitement you deserve.